Welcome everybody, and thank you for joining this, the last live CoinDesk webinar of the year. We're here today with BVNK to discuss crypto lending and its place in the portfolios of so-called traditional investors, such as high net worth individuals and wealth managers. Analysts estimate that the total family office assets under management are now worth more than $6 trillion. And so the questions for the next few years are how much of this will be invested in crypto? Will this be invested directly in coins and tokens or via investment vehicles such as the recently launched Bitcoin ETFs? And also how much will be invested with a view to earning interest rather than just gaining exposure to price volatility? With us to help answer these questions is BVNK Managing Director, Chris Harmser, who worked as an investment analyst prior to joining CoinDesk as head of trading in 2020 and ultimately co-founding BVNK, which only launched in October. Joining Chris today are Nick Martitsch, partnership lead for Compound Treasury at Compound Labs, and James Brockhurst, a private wealth attorney at Forsters LLP in London, where he advises high net worth clients on crypto and crypto lending investments. My name is Nick Lord, and I'm your moderator for today. I have 25 years of experience in financial services communications. A quick note about our sponsor, BVNK. Launched in October 21 and headquartered in London, it is on a mission to build the future of banking. Its BVNK business account enables businesses and investors to seamlessly manage yield, execution, and payments from a single platform. It is setting the standard for digital asset financial services. Now, to kick us off, I will pass to BVNK's Chris Harmser to set the stage for our discussion with a few slides that he's prepared. Chris.
Thanks very much, Nick, and welcome everyone. Happy to see so many participants today. And also thanks to my co-participants, Nick and James, for joining us today. I'm just going to share a quick presentation to set the stage and kind of get the discussion going. Let me share my screen quickly. Great, I hope everyone can see that. Cool, so I'm just going to do a quick plug for BVNK and who we are. BVNK is a digital asset-powered banking platform for investors and global businesses. We currently offer 3 services, the BVNK, or it's anchored by the BVNK business account. We also then allow clients to access BVNK yield and markets through that single platform. It's essentially putting fiat and crypto into a single account. So, the title of the webinar is really crypto lending as a leading alternative investment for high net worth individuals. So, why do investors allocate to assets to alternative investments in the first place and not just stick to the traditional 60-40 stock bond portfolio? And it's largely, I see it as being 3 factors. The first one being diversification and risk reduction, the second one being return enhancement, and then the third one really being yield or income generation. And I think, we're really going to zoom in on the third piece today, which is that yield and income generation piece and how crypto is playing a role in that. So, why is income generation or yield even topical at the moment? It's largely because global interest rates are really anchored at 0% or in most developed markets. That presents quite a challenge to traditional investors looking to earn income in traditional fixed income securities or fixed interest securities, given most of these securities use some sort of central bank rate as the base or the benchmark to be priced off of. So, we've got this global 0% interest rate world. Investors are searching for yield, looking for yield. So we're sitting with a yield-starved world. Inflation is running hot at the moment, as you can see around the world, but we're still seeing central banks reluctant to start raising interest rates and thus keep this low yield environment for longer. I like to use this image more as just an image to kind of put crypto on the, in asset buckets, or where does crypto fit in an investment risk and return bucket. And from that, you can largely see crypto sits far out on the risk spectrum, even above venture capital. Most traditional investors are thinking of an allocation to crypto in this sense is, cool, I start on the far left down here as cash, and then you start from cash and you move out, and you've got government debt, corporate debt, and you move all the way out to equity, venture capital, and now you've got this new asset class, crypto, sitting on the far right of the risk return spectrum. And because of that, many investors approach crypto from a volatility first perspective. And, for many traditional investors, volatility, or even, high net worth, volatility equals risk. And, whether that's right or wrong, but essentially they approach it from a volatility perspective when they're thinking about, allocators are thinking about allocating into the crypto space. I mean, what this really shows is it's a long-term chart of Bitcoin volatility. And as you can see, in 2011, the Bitcoin volatility was much higher, and you've seen this general trend into lower volatility within Bitcoin specifically. And that's largely a function of increased capital coming into the space, but also the specific type of investor that's entering the space. As the more traditional investor enters the space, you're seeing some of this volatility dampen, and it will continue. We believe it will continue to. Bitcoin volatility will continue to come down as the asset class matures. So why is that Bitcoin? Why is Bitcoin volatility important, or when thinking about it? But I think you've got to kind of go back to that asset bucket piece. I mean, I think some of you've seen this data in a multitude of different formats, but it's essentially a traditional stock bond 60-40 stock bond portfolio, and then adding small allocations to Bitcoin, what that does to your risk return or your cumulative returns over time. But very much, volatility is kind of driving that discussion. But some investors might not be ready for that sort of volatility or an allocation to crypto, but still are looking at crypto to, and wanting to participate, but not ready for that volatility. And that's really where we see, the crypto lending market come in. It's a way to access yield. So that third bucket we spoke about earlier, alternative assets, but specific that yield or income generation portion of alternative assets through the crypto lending market. And, kind of shying away from that, it's a nice way to, I guess, dip your toe in without having to take that volatility risk around most of crypto assets. So this way you can enter the market with fixed yields that are generated through different kind of strategies within the crypto lending market. But it's really focusing on that kind of fixed income, fixed interest portion of the bucket, and kind of moving crypto out of that highly volatile top right bucket and into more of the cash bucket, and comparing these crypto yield opportunities that can range, up to 8 to 9% in some of these stablecoin yields, and put them alongside some of the other fixed interest assets in a portfolio, in an overall portfolio. And just to quickly, this really, the crypto lending opportunity exists because of, there's still a bit of the digital asset market is still fairly immature, and that gives rise to a bunch of trading opportunities, market neutral trading opportunities within the space. And what's really happening is prime brokers and other sort of financial institutions are able to lend into that space. And these market participants are willing to pay high yields for that. And we've got some of the market participants listed there on the right, are kind of who are the end borrowers of the capital and where those yields coming from. Cool. And then, just final, then how's BVNK yield? What is BVNK yield? We're partnering with top prime brokers in the space, assessing them on certain criteria, and really giving our clients access to a safe and easy yield generation within the crypto credit ecosystem. And that's really the end of it. I think I'll just hand over back to Nick to kind of take us forward.
Thank you very much, Chris. Very interesting charts there, especially, I think that first one, certainly where crypto was up in the top right-hand corner. If you add in the yield generation things, it moves it a certain way back certainly on the risk factors. I think that's a very interesting presentation from a market participant's point of view. I'm very interested now to turn to James's perspective and to hear about what your high net worth clients are actually saying to you and what the biggest questions are they have around taking crypto positions. What's motivating your clients to enter this space?
Thanks, Nick. Well, it's an interesting one. Taking a step back slightly, my clients are split into two broad categories. First, you've got what I would call the old school crypto whales, and they're motivated, as everyone will know, in no small part by ideology and anti-bank sentiment. So what's happened with DeFi, if you can call what's happened with DeFi a triumph, in some senses it is, that the old school clients are delighted about what's happened in the past 12 months or so. The second category of clients, they're delighted in the sense that DeFi has taken off in a way that we didn't think it quite would. The fact that we're now holding this webinar, the fact that I now have clients who are using crypto lending platforms, I couldn't have said that 2 years ago. I know a lot of these platforms were in the genesis stage back then, but now it's happening, and it's not even just a high net worth clients or the family offices looking at this space. It's everybody. It's really taken off. But I mentioned family offices. They're the other sort of they're the second category of clients, and even high net worths without a family office. But what we're seeing is we're seeing clients with maybe their family offices coming to crypto, people who had no interest in crypto at all 2 years ago, but now they're saying, okay, let's look at allocating a proportion of our wealth to crypto, anything typically from 1% to 5%. And if we focus on family offices, what's motivating them is that very often they're given a mandate to chase higher returns. So if you're managing a family office and you're already pretty heavily weighted in private equity, private debt, hedge funds, then it's not necessarily a huge jump to move towards crypto lending or DeFi platforms, especially if you can incorporate stable coins as part of that. So it's investment driven. There are a number of non-investment considerations that I can touch on now if you wish, because I know you mentioned, what are the big questions. Well, as I say, the crypto whales, they've got complete freedom to invest as they see fit, but family offices, we're talking about institutions here with rules and governance in place. So it's a very different proposition for a family office to turn around and say, okay, let's make an allocation to crypto or to crypto lending. But if we just think about what a family office is, the people who are working for family offices, they have fiduciary roles, which in other words means that they have responsibility, a duty of care to the family, in the sense that they're directors of the family office company, or maybe they're advising a family trust. So they have a very high bar to meet. And if you look inside a family office, very often you'll see 10, 20, maybe 30 people. And amongst those people, you'll have experts in private equity, real estate, public equities. So you have this infrastructure that's built up in family offices. But if you're going to make a move in crypto, then you need to start thinking about expertise in crypto. Because some family offices won't necessarily be in a position to say, okay, we're going to recommend this particular allocation, this particular crypto investment. And that's because certain family offices just aren't built to do that role. Their role is more asset allocation rather than specific stocks or specific crypto platforms. And there might be regulatory reasons for that. It just might be how they're set up. So you need to get the right advisory people around you if you're going to take this splash. And I know a number of family offices are looking at that space now, and they're trying to see, okay, who can actually advise us on moving into this space if we don't have the in-house expertise. And I mentioned allocation. That's another big question, because again, family offices will have a sophisticated setup that have some kind of organized allocation model. I mean, for instance, I think 2 of the family offices that I advise have the Yale endowment model as their allocation model. So effectively, much like Chris, you were talking earlier about asset buckets. I mean, what we have here is, again, hedge fund, private equity, real estate, fixed income. Where is crypto going to fit into those categories? Maybe crypto lending could fall into the fixed income bucket. But I think more than likely, they're going to have discussions with the family, and they are having those discussions now. It's certainly in a couple of cases where I'm involved, because they're going to need the family's blessing. And which members of the family are you advising? Are you advising G1, a patriarch or matriarch in their 80s, who perhaps have a certain view on crypto, or are you advising G2 or even G3, who might have completely different views on crypto? Tax is another thing. I mean, I could go and talk about if you transfer your tokens into a lending pool, you'll normally receive redemption tokens in return. Do we have a crypto to crypto disposal when you do that? So that will be relevant in any jurisdiction, certainly an onshore jurisdiction. So there's lots of questions surrounding this, but these are the questions that are being addressed as we speak.
Okay. Well, I think we will definitely come back to some of those issues a little bit later. I think when we're going to look at the risk components of crypto lending. But I now want to transition to digital asset lending. And Nick, according to your website, the Compound Protocol currently has $19.6 billion, I think, of assets earning interest across 16 different markets. So what prompted Compound's move into the institutional space with the Compound Treasury offering, and how do you approach high net worth individuals, wealth managers, and family offices differently from the, I suppose, the DIY population that contribute to liquidity pools on Compound?
Yeah, great question. For a little bit of background, the Compound Protocol has been operating for the last 3 years or so, produces a short-term interest rate on a variety of digital assets where any person who holds crypto can come to the protocol. They can supply that asset to earn interest, and then they can then borrow against their balance. We've seen this use case mainly used by hedge funds who are looking for leverage and liquidity on their positions. So they'll typically supply a volatile asset like Bitcoin or Ethereum, and then borrow stable coins to chase whatever sort of opportunities they want, or just have liquidity for their business. So what this has produced is this very attractive, very liquid interest rate on stable coins like USDC and DAI. We've fielded interest from a number of institutions, whether they're fintechs or neobanks, asset allocators, endowments, pension funds, who, particularly in a low interest rate environment, are very interested in these high interest rates on stablecoins. However, they're not quite ready to make the leap into setting up all of the infrastructure needed to be able to access those rates. So typically you would need to have a process for converting your fiat into crypto, managing private keys, paying Ethereum network fees, custodying the interest-bearing assets, the redemption tokens that James mentioned, and managing all these in an institutional manner. So with Compound Treasury, our overarching goal is how do we lower the barrier to entry for an institution looking to take their first steps in DeFi and participate in these markets? And what we came up...
Sorry, just to confirm, is that a corporate institution? So like, say, a company's treasury function, or is it more of an institutional investor?
It can be both. We've had a lot of interest from corporate treasuries, as well as hedge funds, people who are looking to sort of incorporate yield into a variety of areas of their operations. And so what we ended up launching with Treasury is lining up all the best-in-class service providers in the background, namely firms like Circle for the fiat to crypto conversion, firms like Fireblocks for the custody and supplying into the Compound Protocol, and abstracted all of the crypto complexity away from these institutions. So with Treasury, we offer 4% on cash balances with daily liquidity, where our users can simply wire in US dollars, earn that 4%, and whenever they want a redemption, we'll wire it back. And we manage everything in the background with the kind of guardrails that you'd expect for an institutional grade product. It's also a bit of an interesting regulatory approach. So it's structured as a exempt debt security in the US. So what is beneficial for institutions is that, one, they can point to a direct counterparty where they're getting the yield from, which some like for kind of regulatory reasons. And then secondly is that they can put that debt security on their balance sheet, and there isn't ambiguity over holding something like CUSDC, an interest-bearing version of a stablecoin on their balance sheet, which raises a lot of tax questions. So our goal with Treasury is to really create, the easiest way for institution to get the benefits of the compound protocol, which is transparency and security and high yield, while minimizing the operational complexity.
That's fantastic. And I think, as you say, as the potential of crypto or digital asset lending becomes more and more clear, this will become more vital, I think, as you say, to take some of the ambiguity and the complexity out of it. I have to ask, do you see any change if interest rates in the fiat world go up? It was announced yesterday by the Fed. They're planning 3 rate rises next year. Bank of England and ECB today, both, ECB didn't, but Bank of England did raise rates. How does that affect what you're offering?
Yeah, it's a very interesting question. And I think what really comes down to is how much demand there is for digital dollars in the crypto ecosystem. When you look at the rate of innovation, where people have high demand for assets like USDC or DAI to go put them in new types of protocols, I don't think that will be highly affected by interest rates in traditional markets. Could have a slight impact. We'll have to see. But there's sort of always been that demand, and I think as the rate of innovation increases, the pace for demand for digital dollars will increase as well. As there's still some friction between traditional fiat currencies and crypto. So there's sort of these bifurcated worlds that will probably last for the next few years at least, that will keep, I think, demand and interest rates high for stablecoins.
Okay, well, that's very interesting, and a good transition to where I want to go next, because Chris, in your presentation, you mentioned how essentially the BVNK yield system works, but maybe you can take a step back and tell us more generally where crypto yield comes from and the differences between each of them and the different potential risks that these sources of yield do entail.
Sure. I mean, I've used the buckets analogy today quite a lot, but I like to put the, crypto yield, it is 3 yield generation buckets, and each of them have fairly different risk characteristics in the crypto credit ecosystem. And the first bucket is really centralized finance, or CeFi, as we call it in the crypto market. But centralized finance is really just traditional prime brokers, banking institutions that are now crypto native, or and have either come into the space or grew themselves into the space. And what they're really doing is supplying capital into this demand for digital dollars, as Nick was saying. So they're the supply side of that demand. They're meeting the demand, and that's probably, in my mind, the least risky, or has the least risky characteristics. And I'll tell you why. Is because this has long been done in traditional capital markets over the last 20, 25 years by banks and traditional prime brokers. So there's an existing playbook. They know what to do. They know how to do it. They know how to manage margin calls, collateral levels, all these sorts of things. And they brought that playbook into crypto, and they are running these. And you've seen a lot of crypto lending in the CeFi space pop up, and there's new prime brokers, and there's been this race for prime brokerage with some of the more prominent players. Yeah, I mean, that being said, where do those yields come from? A lot of the time, it's the traditional players. We had that market participant slide up earlier. It's the hedge funds. It's all these guys looking to borrow. Says that borrower demand. It's miners looking to put BTC on. They don't really want to sell their BTC, but they'll put Bitcoin in as collateral, and they'll borrow dollars against that, to then use. And they're willing to pay high rates of interest for access to that capital, because there's still a bit of a dearth of capital in the crypto ecosystem. So that's the first bucket. The second bucket is really staking. So these are staking rewards. So, this really comes from the proof of stake consensus mechanism, where layer 1 protocols, who are just as your proof of work with Bitcoin, proof of stake, and what proof of stake really does is allows clients to stake their assets or provide assets to secure or validate transactions on the network, and you then earn a yield or reward for that, and that can be computed back to an annualized yield. So that's the second bucket, and staking is fairly limited at the moment because a lot of the time it's largely limited to proof of stake blockchains, so layer ones that are using this consensus mechanism. And then the third bucket is, really where Nick and Compound are playing is DeFi, and these are DeFi protocols. And I would say this is probably the higher risk version of yield generation within the crypto credit markets at the moment. But there's a bunch of weird and wonderful ways you can generate yield in DeFi, things like yield farming and a few others. But in simple terms, it's supplying liquidity into a protocol and earning yield on the back of that. That comes with a whole new kettle of risks, really, and risk we can kind of quantify and know today, and then some like smart contract risk, maybe hack risk of these protocols and that sort of thing. So those are quantifiable risks that we know today. But I think as the market matures, there's probably more unknown risks that we just don't know about yet that are still going to pop up, and those will come to the fore as the asset class matures. So, to kind of summarize, that's the three yield generation buckets within the broader crypto lending market. Is the first bucket is CeFi lenders, which is that kind of traditional capital markets playbook applied to crypto. All that's changed. It's no longer equities. It's now a crypto asset underneath in that market. The second one is staking, which we just discussed. And then naturally, the third one is DeFi, which is a real topical and exciting place to be in, and where a lot of the innovation in crypto capital markets is happening at the moment.
Yes, but the higher the risk, presumably the higher the return.
Yeah, you do get a lot of the rewards within DeFi, come from kind of inflationary rewards to get, kind of token rewards to get people into that platform. So you're getting very eye-watering yield sometimes, but as you say, it comes with a lot more risk versus some of the traditional stuff.
I want to ask James now, is it easier to advise clients on crypto lending opportunities that mitigate some of the price volatility risk against these sort of riskier but potentially higher yield investments in DeFi? So what are your clients' concerns around DeFi investments in general?
Definitely. 100%. If you can reduce that volatility by, I assume you're referring to use of stable coins through lending platforms, then that is very attractive. If you can especially if you can use a reputable stable coin, and then if you're getting 8-9%, then that's wonderful. There are that said, of course, there's always going to be risks, and to a certain extent, the high yields price in those risks. As I said earlier, if you're in a family office setting, then you'll want to certainly have a look at has the platform been financially audited? In other words, is the liquidity pool significant enough to cover loss? What about security audit and hacking risk? And basic questions: how much is held in hot storage, for instance? And then to what extent is the platform or indeed the token regulated? And Nick just referred to compound status on that, which is really important, because ultimately, again, speaking from a family office perspective, if you're working for a family office as a chief investment officer and you're on a fixed term contract, you don't necessarily want to stick your neck out, and you want to make sure that all of those issues I've just mentioned are watertight.
It's the old adage, isn't it? You never get fired for investing in Goldman Sachs. But at the same time, this takes a very different set of analytical skills to really assess what the risk return opportunity should be and can be. It's not like buying a bond and assessing the credit risk by looking at a rating agency and then multiplying that by the term of the bond. This is very different stuff. So, Nick, what's your take on DeFi lending against Bitcoin or USDC and other stable coin based lending, and how are the regulators actually going to play a role in how we can quantify this?
Yeah, I think there's some major differences between centralized lending of digital assets and then DeFi. We don't actually use the term lending because all borrowing is over collateralized. but DeFi borrowing markets, let's say. So with the compound protocol, when you're supplying assets into the system, there's no humans in the loop who are actually taking custody of funds or setting interest rates or underwriting any loans. It's all executed autonomously with code, where assets are serving as the collateral. Interest rates are set by the supply and demand of borrowing for each asset. So when you think from a risk perspective, it really transfers the risk from what you might find in a traditional loan book, which is counterparty risk of whoever is sort of administering these loans, and any default risk of who is borrowing the assets. And it transfers that into, I think, more concentrated into economic risk and code security risk. And I'll unpack those a little bit. The code security risk, as was previously discussed, is, are the smart contracts for Compound the code that is moving funds and allowing people to only withdraw what they're supposed to be able to withdraw? Will it be able to hold up against, attempted hacks or exploits? And then the economic risk is that even if the code does hold up, are the different incentive mechanisms that are layered into the Compound protocol, like the margin engine that incentivizes these liquidators to come in and repay at-risk borrowing positions if they ever get close to exceeding their collateral ratios? Will those operate as intended if there is volatility in the markets? I think protocols like Compound, other large ones like Aave have really kind of shined through periods of volatility. So I would almost say it's a different sort of uncorrelated risk than you might find with a traditional lender, but both are extremely interesting and I think have room in portfolios. And then in terms on the regulatory side, it's absolutely an evolving space. I think one of the benefits people like about Compound Treasury is that, as I mentioned, they're able to sign a financial agreement that they're more familiar with a specific US-based entity, Compound Prime LLC. And then our business is very comfortable using these open permissionless protocols in the backend to power those offerings. And we worked extensively with outside and inside counsel to sort of come up with those strategies. So we've sort of done the homework and try to position it in a way that's very palatable.
Sounds like the best of both worlds. Now, I just want to remind the audience here that we do have a Q&A function. It's somewhere on your screen, I think, on the right-hand side. We've got a few questions that have come in already, but we're going to open it up for a bit of a longer. I'll address those right at the very end. So if you have got some burning questions for the panel, please don't hesitate and write them in now, and we'll try to get through them as we move towards the end. So I've now got one final question for the group, and I'd like to hear from each of you in turn. So what are your growth predictions for digital assets in 2022? Do you see crypto lending becoming the best alternative investment next year compared to the traditional vehicles? And why? What are your predictions? Perhaps we can start with Chris.
Well, I mean, it's fairly difficult to put a number on what you think is going to happen in the crypto market next year. But I think I'd maybe I'm looking at it probably from a different space and really kind of what sort of investor is going to be entering the market next year. I mean, this year we had a lot of institutions coming in, and we think a lot of mainstream corporates are looking at the space, are kind of hovering around from the treasury perspective. So there's this, you had retail institutions starting to come in. There's still more institutions to come in, and naturally, maybe corporates starting to really participate in the space. And then what does that new type of investor inject into the crypto market? It's kind of how I'm thinking about kind of what that means for the crypto market next year. Is I think with this new type of investor coming in and probably entering through Bitcoin, there's probably an increased correlation with digital assets and traditional risk assets. And that increased correlation, that's kind of one kind of theme that I'm looking for next year. And so kind of digital assets being more coupled with traditional financial markets. And then I guess a few crypto specific trends that I'm keeping my eye on, or crypto lending specific trends versus putting any kind of predictions on. And I think there's a lot of players looking at we discussed that CeFi lending and the dearth of capital, the lack of capital in the space that's driving some of these high yields in stable coins because of that borrowing demand. I think there's a lot of banks and traditional financial players looking on the outset and looking at these juicy yields that they can make. They're sitting with a bunch of capital on their balance sheet that's making 1 or 2% in normal lending products. So I think they're going to start looking at that and And as that capital comes in, that supply and demand balance, starts changing, and maybe that puts a bit of pressure on some of the centralized finance yields we're seeing. And then one that I'm, it's a trend that's probably, pretty important, and one that I'm watching for next year is really the rise of uncollateralized lending, because most of the crypto market is still an over-collateralized lending market. And what that really means is it's obviously much safer. You get a much safer yield, because for every $1 of borrow, there's about 1.25 or 1.5 worth of crypto asset posted as collateral. But most people, most of the world's debt markets are run on an uncollateralized basis. And if you really want the crypto credit market to see exponential growth and not just stay in line with the broader crypto market growth, i.e. the crypto market cap growth, I think you need to tap into uncollateralized lending. And there's a few DeFi protocols that are doing this already, looking at uncollateralized lending. So I think that's an interesting space to watch. And if that one gets, really starts heating up next year, I think the broader crypto lending market can probably grow ahead of the broader, crypto, the entire crypto ecosystem from a market cap growth perspective.
That's great. Nick, perhaps you'd like to give your predictions for next year.
Yeah, I think we'll see a lot of growth in the sort of blending of DeFi and maybe more traditional stablecoin lending into the traditional financial system. There's been a trend over the last year that I think is going to accelerate, which is centralized institutions offering products, experiences, services that are powered by decentralized finance in the back end. I think one of the best examples of this is Coinbase launching a compound integration last week. So sort of bringing the yield to where the users are, instead of making users, kind of go chase different opportunities. While it's happened a lot with crypto native institutions, I think we're seeing a lot of appetite from fintechs, other asset managers, to kind of embed these yields into different types of their products and operations. And really just bring it to the masses. So I think that's one of the largest trends we're going to see over the next year.
That's great. James, what are you looking out for? What are you going to be advising your clients about this time next year?
Well, it's interesting because about a week or two ago, one trader who I act for said, I'm thinking of retiring from the whole crypto thing. I think I've had a good run, and I think the market is going to mature. And I thought that was very, very interesting when you contrast that with some of the conversations I'm having with family offices. But it just shows that the market is maturing. If a trader's taking that view, maybe eyeing the exit, but a family office who ultimately are looking for stability and less volatility are looking to enter, all those issues to do with family offices that I explained earlier, they will be resolved. Those family offices have to, for instance, come up with a new asset allocation model that will resolve within the next few months in those cases. So you will have those new arrivals in the market in 2022. Some things won't change, of course. The old school crypto whales who always promise to diversify will not sell. They never do. But I mean, in terms of banks utilizing DeFi type protocols, I mean, that's fascinating. The idea that we've seen recently of banks actually offering lending based on crypto collateral. I don't know how they can do that, but stay competitive with the DeFi markets, because of the fact they'll obviously be taking their profit share. So, but they'll have a go. They'll certainly have a go. One thing I haven't touched on as well, in addition to family offices, trusts. Some of the world's largest wealth is held in family trusts, and trust companies have not been comfortable so far holding crypto, and that's largely around custody, compliance, and those kinds of issues. The private wealth world is about 5 years behind the corporate world. Funds have proliferated for the last 2 years in places like Cayman, whereas when I speak to trust companies in Channel Islands and places like Cayman, they're not quite ready in the private wealth sense to take on trust money. But that, again, is changing. The conversations going on right now are changing. So that's another, that will probably mean more money coming in. But again, they'll be attracted to the stability that comes with the staking of stable coins, for instance, or lending of stable coins.
Yeah. And with all that money, as Chris said, the returns will naturally come down due to the laws of supply and demand still actually operate even in the crypto world. I want to address a couple of the questions that have come in from our audience now. We've had a number of questions, and I think we've answered already a few of them. But Chris, a question for you. How exactly do you quantify smart contract risk?
Yeah, I mean, it's pretty difficult to do, but it's more about kind of the risk around, is the smart contract doing what it's supposed to? So it's more smart contract protocol risk, and about kind of, I guess the best way to describe that or how to check for that is bounty programs and, white hackers that are trying to attack the code, and kind of giving you those reports around that and rating that. I don't know if there's a unified scale to kind of rate that just yet. It's probably developing, but I think in time you probably get to a point where, similar to credit rating agencies, you have some sort of generalized framework that people are using to assess these smart contract protocols and how susceptible they are to either hacks, backdoor attacks, these sorts of things. So I don't think there's a quantifiable measure just yet, but I think there's a lot of work to be done to get a unified framework around that.
Okay, so another opportunity for alongside James's view that you need to have an advisory firm that sits between family offices and the crypto market players. Okay, another question. Can you please share the uncollateralized crypto lending protocols that are emerging? Yeah, Chris, I think that again is for you.
Yeah, so the two that just popped into my mind when I was, having a chat there, is Maple Finance is one of them, and there's another one called Goldfinch that are kind of just jump into my mind, while I'm thinking about that. Those are the kind of two more prominent ones, but there's a few others floating around and the names escape me at the moment. Okay.
A question for anybody, these are two really two geographically based questions. Firstly, where is the best place for an RIA firm to manage fee-based models for clients? And secondly, is the US still the leading market for crypto lending and borrowing, both of them, or are other markets catching up, such as the UK? James, perhaps you might be able to touch on this first, and then we can come to the other two.
From what I can see, the US is still leading. The UK has great fintech and crypto scene, but it's the number of protocols here compared to the States is still, I'd say, a small fraction. That's certainly my perspective. It's hard to see that changing. It's hard to see the scale completely tipping, but that's probably my perspective for now.
Okay, Nick, does that chime with your experience?
Yeah, I think so. I think there's some sort of uncertainty with regulatory postures in the US, but overall, there's just so much talent building in the space, so much momentum behind it that I think while it is a global phenomenon, we're still seeing a lot of activity and momentum happening in the US.
Okay, great. And do you have any views on where the best place for an RIA to earn their fees from?
That would be a tricky one. That's not really my area of expertise on kind of tax and geography, but I'll let maybe one of the other panelists share their thoughts.
Anyone? I think it's where the fees are highest, wherever that is, which might be where to set. There's another question, just very briefly. I'm not sure this is entirely relevant, but it says, today we're experiencing a big high-tech sell-off. How do you think it will affect crypto prices? Is there a correlation between Tesla and Bitcoin? Who would like to have a go at answering that? Chris?
Yeah, I mean, I think naturally, given, crypto is a new type of technology and large cap growth tech stocks is probably the closest thing or analogy in the equity market that you have to it. And Tesla's got a tiny portion of Bitcoin on its balance sheet, and Elon loves Doge. So I do think there's some correlation to kind of high tech growth stocks and just, bucketing in that kind of general risk asset bucket. But yeah, I don't think today's sell-off, I'm not, I wouldn't opine on what that would do to crypto prices, but I think there is more correlation that we've seen over the last couple of weeks, or especially since early December in the crypto market, with some of the utterings around central bank interest rate raises and these sorts of things that are kind of seeping into the crypto market.
Yeah. Great. Well, we are bang on 45 minutes. It's been an absolutely fascinating discussion. And I think it has really shown not only the reasons why crypto lending should be a part of certainly high net worth individual investing, but also how it can be done and what are the things you need to look out for. I think we've looked at the various risks involved. We've looked at the structure and the makeup of the returns, where they're coming from. And I think we've seen how this can be, I suppose, turned into a framework for how to look at including crypto lending as part of a investment portfolio. I think we've seen that there are obviously lots of changes still to come. There's probably a lot more money to come into the system, and there are opportunities there for either new advisory firms advising the family office market, and again, there are obviously going to be lots more developments next year in terms of DeFi products and protocols and how this all fits together. So I want to thank the panel very much for your insights. It's been a wonderful conversation. I want to thank all the audience for watching, sending in so many interesting questions. And I want to wish you all a very happy holidays. This is the last CoinDesk webinar of the year, and we look forward to seeing you in 2022. So goodbye.
Cheers. Thanks very much.